to cover an interesting and certainly useful topic for individual traders, which is formed up as standard wave models. And today's webinar is the first part in Elliott Waves from A to Z series. During this series, we will cover main and more professional rules of Elliott Wave Theory. So if you are feeling interested into this topic, please follow our updates as we are going to provide this series on a weekly basis each Wednesday during September. You are mostly welcome to join us. And for today's agenda, we are going to cover common rules of Elliott Wave Theory. We will learn standard wave theory models. We'll see how to count the waves correctly, and finally implicate these standard wave models in our trading. Before we start, I would like to learn a bit more about you. As for me, I'm trading since 2008 and have recently focused on so-called naked trading or trading without technical indicators. This method includes Elliott Wave tools that we will examine during today's session. Some of you have also got some experience in individual trading. Then you probably know that any winning trading strategy won't be working sustainably without a proven and trustful partner. This is important to be educated not only in trading skills, but in trading conditions as well. So please have a look on features offered by Tickmill. If your broker doesn't provide you with such essentials as competitive spreads, segregated funds, or lack of free quotes, you'd better think of it once again. So digging into the wave theory, it all started with American scientist Ralphson Elliott, who has come up to general wave principles described in his book Nature's Law, The Secret of Universe. The Nature's Law gives two main insights on the rules of regularities that were indicated by Mr. Elliott. At first, any trend move consists of 5 waves that include 3 impulse waves in trend direction and 2 correction waves, which direction is opposite to trend. It's easily counted as 1, 2, 3, 4, and 5. Second rule is formed up like follows. Once trend move is completed, correction follows. It consists of 3 waves, 2 in correction direction and 1 opposite to it. Usually it's marked up as A, B, and C. You may wonder which are the deductions of Nature's Law. So the first rule of them is that they are universal to any time frame and simply to any kind of mass process. It's interesting that you can analyze not only financial markets using Elliott Wave Theory, but also climatic changes, natural changes, or even psychological mass behavior. Second idea behind Nature's Law is that it's scalability. That means that all waves consist of smaller waves of same structure and are part of bigger waves themselves. This concept is easily described in the standard Elliott wave cycle as depicted on the screenshot. As you can see, complete market cycle is divided into 2 parts, the bigger impulse and the lower correction. So the impulse part of the cycle is moving into direction side, and correction has got an opposite direction. As depicted, impulse side is divided into 5 parts, which are marked with numbers from 1 to 5. And the correction part is divided into 3 parts, which are marked with letters from A to C. Interestingly to notice that each of the parts, as described on the chart, consists of smaller waves as well. So if you have a look on the first part of impulse trend, it is it consists of impulse trend waves of a smaller scale as well, and they are marked with smaller as well. As for the second part of the impulse trend, by its nature, it's a correction wave, so it consists of 3 parts which are marked with letters of smaller size. Now let's have a look how it looks in the real market trading. As an example, I'm taking today United States dollar to Japanese yen currency pair, which is one of the most popular financial instruments for currency traders. We start from bottom around 115.25 when the first waves finishes above 120. The bottom of second correction wave falls below 116, but stays above the beginning of the first part. Then we see that third part of the wave is being developed into in an extensive mode. So we can see 5 smaller parts of its direction, but it clearly has an impulse move as well. And finally, there is the first part, which is which stays above the beginning of third wave. And if you are able to see, this chart finishes in April. So if you are curious, you may open your charts and see what happened during the April. If you are following USD to GPY currency pair, as me, you probably know that the pair has gone beyond 125 value. And that was the 5th part of the impulse trend. Today we are starting with trend impulse, which is a basic model for trend moves. Impulse is a model of 5 waves. 3 of them are trend waves of same structure as trending, so 5-wave structure, and move along trend direction. 2 of them are corrective. So inner structure for such model is 5 to 3 to 5 to 3 to 5. On the given scheme, trend impulse is depicted here. Let's learn main rules for trend impulse. First, wave number 2 never retraces more than 100% of wave 1. In other words, wave 1, the beginning of wave 1 should always be below the wave 2. A second rule is wave 3 cannot be the shortest of 1 to 3 to 5 waves. So between all of the waves, wave C should not be the shortest. If you see that wave 3 is shorter than wave 1, you have got two probable solutions. Either wave 5 will be even shorter than wave 3, or wave 3 is going to be extended, or we are seeing a different model from trend impulse, because it's an obligatory rule for this kind of model. Third, wave 4 doesn't overlap price range of wave 1, except from diagonal triangle. But we are going to move into exceptions a little bit later. Finally, wave 5 finishes above wave 3. So that is the depiction, once again on United States dollar to Japanese yen, of how trend impulse looks onto real charts. This is a 30 minutes time frame, so if you are trading this pair, you should be familiar with the trading range. We are starting from last Friday, when during the NFP data publication number, United States dollar to Japanese yen have posted the bottom around 119.50. After that, it has developed the five-way structure. So let's see step by step how the rules are being held by this example. So the first rule was wave 2 never traces more than 100% of wave 1. So the beginning of wave 1 is marked here, and the bottom of wave 2 goes above 190.80. So clearly on the chart you can see that wave 2 doesn't go below the beginning of wave 1. So the first part of the rule is completed correctly. Next concept is wave 3 cannot be the shortest of waves 1, 3, and 5. Here again, we don't even need to use linear options here. As you can see, the price range for wave 1 is definitely shorter than the price range for wave 3. So this rule is completed correctly too. Going next, wave 4 doesn't overlap price range of wave 1. And here again you can see that the bottom of wave 4 is between 119.60 to 70, whereas the top for first wave is below 160, 190.60. So the waves 1 and 4 are not overlapped with each other, and this rule is being held correctly. Finally, wave 5 should finish above wave 3. As you can see, the top for wave 3 is made up at 120.20, and the current price action has gone closer to 121. So according to the main rules of trend impulse, the price action we are seeing now on the USD GPY chart is correct accordingly to trend impulse specifications. If you're already familiar with Elliott Wave Theory, you may probably notice that one of the main questions that appears when analyzing wave structures in currency instruments is, what should we do if wave 4 overlaps the top of wave 1? Well, there are three possible outcomes. The first idea is that wave 3 is not yet completed, and we are meeting with the example of extended wave 3, and you just need to wait and see the upcoming market action. Second probability is that model is different from trend impulse and simply might be correction structure. Finally, another option is that model is a terminal impulse, which is a specific kind of trend impulse, and we are going to cover it in our next webinar. If we want to analyze trend impulse further, we need to learn several regularities of alternation rule. This alternation rule applies mainly to corrective waves, which are marked to waves 2 and 4. And these waves should correspond to some of these requirements. Just to bring you extra attention that I tell only some requirements, because in real market trading, it's really hard to see that all of the suggested 4 regularities are met in the same case. So behind the idea of alternation rules, it's enough to see at least one of the rules completed. You don't need to mess it with main rules, because main rules should be completed 100% and all of the specifications should be met. But for alternation rules, even if one of the regularities is being met, then it's considered to be true. So digging into the example, the first part of international rule, alternation rule says price range for waves 2 and 4 must be different at least for third, or using Fibonacci number 38.2%. Second, correction structures for waves 2 and 4 should be different. Third, waves 2 and 4 should have different timing. Finally, retracement ratio for waves 2 and 4, which they represent as corrections, must be different. Let's see if any of these rules are being applied on our chart. So we are going back to United States dollar to Japanese yen. So what we can say if we compare waves 2, which are here, and waves 4, which is marked here. So definitely by memory, quite obvious that the timing for waves 2 and 4 is different. The time that has brought the market to make up wave number 2 is definitely longer. I would say 3 times longer in comparison to the time for wave number 4. So that is the example of completed alternation rule. Retracement ratio for 2 waves is different as well. As you can see, wave number 2 covers most of the price range of the previous wave 1, whereas wave number 4 covers just third, not more than a half, of previous wave number 3. So this is the example of different retracement ratios for the pair. Can we say that correction structures for waves 2 and 4 are different? Well, in order to analyze it correctly, we need to dig more into different kinds of correction models. Just getting beyond, we are having 16 main possible correction models in Elliott Wave Theory, which we are going to cover during the series we are handling now. So it would be possible for us to return to this question later. At least we can say that in given example, we definitely apply to 2 from 4 regularities of alternation rule, and this goes as a confirmation for trend impulse structure. Very important part of Elliott wave analysis is the verification of trend impulse, especially if you're covering it in live mode when it's being developed alongside with your trading. So the first tool for trend impulse verification is 0 to 2 line. Different lines are being shown on the chart. This chart is already familiar to you and covers the same time frame from USD to GPY. And this signal line should not cross any of other lines. And this line helps us to understand where should we mark the finish of wave number 2. So we have got 3 different candidates for the wave 2 start. Here, here, and here. So we have connected 0 level where the Elliott wave trend impulse structure supposedly started as its current bottom, and have made trend lines through all of these candidates. It's quite easy to see that the only line which was not covered during the consecutive trading was the third one, and this is why we have chosen it as the mark for wave number 2 and the start for third wave. Another rule for wave verification suggests us to connect the finish lines for waves 2 and 4, basically of 2 correction waves. We are trying to do it manually, so probably it will not be as precise as on the chart, but if we correct wave 2 and 4, we will see that it's crossing the price value for the consecutive trading, and that gives us doubt for the consecutive trading. If this verification doesn't pass, we are having doubt if the previous trend impulse structure was correct or not. By idea, the signal line which connects waves 2 and 4 should not cross the price value of the currency instrument until it's been finished. As shown on the previous chart, it's quite easy to notice that price value falls below the signal line before it finishes on the wave number 5. So the suggested idea is to change the layout for the given example using the extension rule for trend impulse. Basically, extension rule helps us to divide price ranges for impulse waves. That means waves of number 1, 3, and 5. According to extension rule, any of these waves should be extended. The rule behind extension says that the length of any of the given waves should be 161.8% bigger than a different wave. There could be 3 types of extensions. The first example is the extension of first wave, when wave number 1 is the longest one. That means that wave number 1 should be at least 1.6 times bigger in comparison to wave number 3. And I compare it to wave number 3 specifically because the core rule for trend impulse says that wave 3 should not be the shortest. So in a given example, in case the first wave is the longest one, it's likely to see further a contracting structure of a contracting triangle when each consecutive wave is shorter than previous one. The most popular example of extension rule is the extended wave number 3. Going back to the chart depicted, I believe this is the right case for Elliott wave example given on the chart. So I have changed the initial layout and have marked the supposed top of wave number 3 as first part of an extended wave 3. Then the previous wave 4 is marked as the second part of extended wave 3. Given to this idea, third part of extended third wave is located at 120.70. Fourth part of extended wave is in area of 120.40. Here it's interesting to note that since it's a trend impulse wave by itself, but of lower scale, the bottom of wave number 4 doesn't overlap the top of wave number 1, which finishes just above 120.20. So once again, it's a valid suggestion and a valid model. Finally, wave number 5 could be finished at the current value of 120.90. If that is true, we see a live example of extended wave number 3, which consists of 5 parts. And until the model is not finished, we need to see if wave number 4 develops correctly. So what do we know about wave number 4, which should develop? If we are going to cover it live, we need to get back to alternation rule and remember that wave 4 should have a different time mean in comparison to previous correction wave number 2. It also needs to have a different retracement ratio, different lengths, and probably different structure. As for the core rule, we need to watch closely price area of 190.60, which is marked as the top of the first wave, and wave number 4 should stay above the given price level. In case we see that price goes below the selected price range, we need to have a different look on the wave structure for the given example, because probably we will see a different model, different from trend impulse wave. So let's get back to main rules now and double check if the new suggestion. Let me remind you that we have relooked our initial suggestion of trend impulse after we have connected initial waves of 2 and 4, and so that signal line crosses the price value, which is not correct. And the supposed example suggests the extension rule, and see if it's appropriate or not. So once again, wave 2 should not retrace more than 100% of wave 1. Wave 3 cannot be the shortest of waves 1, 3, and 5. Wave 4 doesn't overlap price range of wave 1. And wave 5 finishes above wave 3. The main section we need to check is this extension part of wave 3. So clearly, wave number 2 finishes well above the beginning of the first part of the wave. Wave number 3 is not the shortest, especially in comparison to fifth wave, which in current scenario is the shortest one. As it was highlighted below, wave number 4 stays above the top of first wave. And clearly again, we may not know the actual finish of wave number 5, but its value definitely already stays above third part of the wave. Going back to extension rule as a general idea behind trend impulse, the third option for extension is wave 5. It is believed that the extended fifth wave is the most rare example in Elliott wave analysis. Yet, when it happens, the fifth wave can be significantly longer in comparison to other waves. As a general rule, fifth wave could contribute to 261.8% or 2.6 times longer in comparison to wave number 1 or 3, but usually doesn't go beyond it. I believe that the given example is very actual and very useful for understanding the concept of Elliott wave trading and Elliott wave analysis, because by its nature, it is very dynamic, and you should always relook your view on the patterns and wave models as they are constantly evolving. One thing is that you're covering historical models which happened several months or even years ago, but the truth behind it is that analyzing previous models doesn't bring you much to your daily trading. If you want to use Elliott wave trading efficiently in your intraday or daily trading, you need to always adapt the ongoing market reactions and um, changes in currency values to the rules of Elliott wave principles. As you can see, you will regularly meet with the need to have a different look on the wave structure, but it should not demotivate you because the main rules and core principles of Elliott wave trading are well formulated, and there are just few of them. So if you are seeing that this model does not correspond to them, you probably see a different model. But this exact case is very interesting to follow. If you're covering this session live, please save the template for USD to JPY on intraday time frame. You may use 15 minutes time frame, 30 minutes, or hourly time frame, depending on what's more useful for you, and see how the price action develops from the current case. As for me, I will store this example as well, and will give you a short wrap up in the beginning of the following session to see how it develops. At the moment, our assumption is that we are seeing an trend impulse, which is not yet finished, with an extended third wave. And currently we are expecting the making up of wave number 4, which should finish above 190.60. And afterwards, we are likely to see one more wave, which goes above 121 exactly. Alternative scenario is that this model fails to become a trend impulse, and the bullish market action can finish at the current stage around 121, and the price will turn into a bearish direction. So the confirmation for it would be the price falling below 190.60. So we are going for a conclusion of this part of the webinar. If you are having any questions or doubts, please let me know in chat section. So I will try to explain you some details of our topic in more details. As for conclusion, Elliott Wave Theory is based on universal and scalable nature's law. All waves are divided into trend and corrective waves. As for trend impulse, which we discovered in details, it has got 5 to 3 to 5 to 3 to 5 inner structure. It's important to note that trend impulse follows alternation and extension rules. Once you test these tools on demo account, it's high time to check its performance live. That is the right time when Tickmill can help you. The broker offers you classic account where you do not have to deposit as much and where the trading conditions are nevertheless great. With Tickmill's classic account, you can enjoy trading with quite a low spread that starts at 1.2 pips on Euro USD. In addition to this, there are absolutely no commissions attached to this account. This is quite an important feature for the beginners, as it lets them to focus primarily on the market without spending time on calculating the profitability due to the commissions. Hi Theodora, thank you for the question. What time frame is most correct for counting waves? Because it's different on each time frame. So going back to nature's law, it's important to understand the concept of universal wave count. As you can see, each wave structure, each wave model consists of smaller waves and is a part of bigger waves as well. So my answer is that you can find waves on any time frame. It's quite obvious that the bigger time frame is, the more substantial and the more proven is the example. I suggest you starting from 15 minutes time frame for analyzing intraday movements, because on lower time frames such as 5 minutes, 1 minute or tick chart, the changes in price action happen too often, so you won't be able to identify and implement the wave structure correctly. Did I answer your question? Cool. Then that's it for today's session. You're mostly welcome to join us next Wednesday when we are going to describe and discuss in details different correction models according to Elliott Wave Theory. I hope that you found this session useful, and I believe that it brings you order and harmony in your trading. So good luck and have lots of pips. Bye.